Hello, and welcome to some demonstration videos, really. Uh, in class last week, we worked through a number of exercises from Chapter 6, which is differential analysis. So what I thought I would do is to kind of redo those problems in an online format, recording, the solution basically to give you guys a little bit more practice, right? So, the first exercise we're going to work on is going to be exercise 6-2. Okay? That is on page 310 in your book. So, you should have your book opened and just kind of following along with the problem. Okay? So, if you will recall, in exercise 6-2, this was an add or drop decision. Okay. Sometimes in business, managers have to make decisions on should they keep or should they drop maybe a particular segment, maybe a particular product line. So that's really what we're going to do here. Okay, so I'm going to refer you back to page 310 to just look over the data, right? Regal Cycle Company, they manufacture 3 types of bikes. They have a dirt bike, a mountain bike, and a racing bike. They also provide us with data on the sales and the expenses for the past quarter for each product line that the company has, meaning the dirt bikes, the mountain bikes, and the racing bikes. So management's concerned with the fact that, hey, you know what? Our racing bike line, we're losing money, right? Net operating income, or specifically, there's a net operating loss of $9,000. Okay? So what we need to do is determine what would be the benefit of dropping that product line. Okay? So remember, anytime we do differential analysis, the key is to identify what benefits or what costs differ between the two alternatives. Okay? So the first thing we have to do is we have to determine, is there a financial advantage or a financial disadvantage for us to discontinue the racing bikes. Okay? So, as you're looking at the book, you could see that, well, if we get rid of the racing bikes, we're going to lose sales revenue of $60,000. We're going to lose variable expenses of $33,000. If you look below that, it also shows that the contribution margin, $27,000, that is also going to be forgone, right? If we drop the racing bike division, we lose that $27,000 in contribution margin, okay? Now, think back to when we first introduced the contribution margin. It's a very important number, right? Contribution margin is what is left over after variable expenses have been deducted from sales. And the contribution margin goes forward to cover any of our fixed expenses, okay? So, the first thing we should recognize here that is if we discontinue the racing bikes, right? Yes, we're going to lose that $60,000 in sales. Yes, we're going to lose or we're going to gain actually those variable expenses, that $33,000, right? However, because that contribution margin is such a powerful number, we can forget about the sales and we can forget about all those variable costs, and we can jump right into this by focusing in on that contribution margin. Okay? So if we lose if we lose or if we drop the racing bikes, we lose $27,000 in contribution margin. Okay. Now, there's some fixed expenses that we are going to also eliminate. Okay. Well, that's a benefit to us, right? If we drop the racing bike division, we're not going to incur some of these fixed expenses. So what we need to do is go through and identify what fixed expenses differ between us keeping the racing bike division or dropping the racing bike division. The first cost we have is our advertising, right? Specifically, the traceable advertising expenses, okay? Well, let's think about that. These advertising expenses are traceable to the racing bike division. If we drop the racing bikes or the racing bike product line, guess what? We do not incur that $6,000 fixed expense, okay? The next cost we have is our depreciation of special equipment. Well, depreciation is a sunk cost. Sunk costs never, ever, ever enter into our decision making, okay? It's a sunk cost. The cost already happened. It doesn't matter what we do now or in the future. We cannot change the fact that we had that cost, okay? So depreciation, not going to include it. The next line item we have is the salaries of production managers. Well, let's think about that. If we get rid of the racing bike division, do we still have to pay the salaries of the product line managers? Well, the answer is no. If we discontinue racing bikes, the salaries of those product line managers goes away, right? We're going to lay them off. So that is a very important cost. It differs between the two alternatives. So guess what we're going to do? We're going to show that, hey, this is an actual benefit that we gain by dropping the racing bike division. So we're going to put in salaries, and that's $10,000. Okay. The next line is the allocation or the allocated common fixed expenses. Okay. Well, they're fixed expenses that are common. However, incorrectly, I might add, this management team allocated those common fixed costs to each of the product lines. Well, right off the bat, that's incorrect, right? They're common fixed costs. If they're common, we do not allocate them to a division or to a product line, okay? But here's the other thing. We can ask ourselves, well, the allocated common fixed expenses to the racing bike division, those $12,000. If we drop the racing bike division, do those allocated common fixed expenses go away? No. They're just going to get reallocated to either the dirt bikes or the mountain bikes. So, allocated common fixed expenses, they're not different under our scenarios, right? It's not a relevant cost to us or a relevant benefit to us. So, we have now identified everything that is relevant with our decision to either keep or drop the racing bikes. So, what I'm going to do is I'm going to add up the benefits that we're saving, right? Well, they're relevant costs because they're expenses, they're costs, but if we get rid of them, well, we're saving $16,000 from the racing bike division if we get rid of that product line, okay? So now we're going to add up our two numbers. The relevant benefit, which is the contribution margin of $27,000, and the relevant costs of advertising that's traceable and the salaries of the product line managers. we see that we have a negative $11,000 here. What that means is we actually have a financial disadvantage. And okay, so what would happen then if we dropped the racing bike division? The benefits, the relevant benefits, are greater than the relevant cost that we save. So there's actually a financial disadvantage of us discontinuing these. Okay. So the answer to number one is, what is the financial advantage or disadvantage per quarter of discontinuing the racing bikes? Well, that answer for number one, sorry about that, is $11,000. Question number two asks, should the production and sale of racing bikes be discontinued? That answer is no. It should not be discontinued. Okay, because if it is, if we do, we would actually incur more of a loss. We would have a financial disadvantage of dropping that. Okay. Now, for sake of argument, number three wants us to prepare the contribution formatted, the contribution formatted income statement, but more specifically, they want us to prepare the properly formatted version. Okay, so we're going to work on our segmented income statement. We've already seen this. This should be a review. Okay, so I'm going to list out my sales. I'm going to list out my variable costs, my contribution margin, the fixed expenses or the fixed costs. We have our advertising, which is traceable. Okay. We also have the depreciation on equipment. We have the production line, production salaries. And those allocated fixed costs, it's totally incorrect, right? So we need to list the segment margin. And then we can subtract out, sorry about that, we could subtract out the common fixed costs. Then hopefully we have an NOI. Okay, so what we're going to do is just show that, well, we have our total column. We need to prepare one for the dirt bikes, the mountain bikes, and the racing bikes, because we're not going to get rid of the racing bikes. So we're just going to go ahead and plug in our data, right? We know that total sales are $300,000. We know the sales for the dirt bike division are $90,000. The sales for the mountain bike division are $150,000. Oh. And the sales for the racing bikes are $60,000. The variable cost in total is $120,000. The variable cost for the dirt bike division is $27,000. $60,000 for the mountain bike division, and we know that the racing division or the racing product line has $33,000 of variable costs. We can then go ahead and calculate the contribution margin in total and per unit. Okay. Then we could subtract out all the traceable fixed costs, right? Anything that we could trace to a specific product line those are the fixed costs that we need to subtract from the contribution margin so we could determine what our segment margin is. Okay? So total traceable fixed costs are 30 grand. For the dirt bike division, they're 10,000. They're 14,000 for the mountain bikes and 6,000 for the racing bikes. The depreciation on the equipment, in total, it's 23,000. However, the dirt bike division has depreciation of 6,000. Mountain bike division has depreciation of 9,000. And 8,000 is the depreciation from the racing division. Then we can go ahead and put in our product line manager salaries. Well, in total, it's 35 grand. So the manager of the dirt bike division, we pay that person 12,000. The mountain bike division, that salaries of the production managers is 13,000. And for the racing bikes, the racing bikes, we know that's 10,000. Okay. So we can now go ahead and calculate what our product margin is. What our segment margin is. We're going to take the contribution margin and we're going to subtract out the traceable variable expenses, the depreciation, and the production manager salaries. Okay. So I did it to one column. I'm just going to click and drag down to do the same exact thing, right? What am I doing? I'm in the dirt bike division. I took the contribution margin and I subtracted all the traceable fixed costs to the dirt bike division. Did the same thing for mountain bikes. Again, I started with the contribution margin. Subtracted out all the traceable fixed costs that were traceable to the mountain bike product line, and did the same thing to the racing bike product line. We now have the segment margin. Okay, we can see here that the total allocated common fixed costs are $60,000 in total. Okay, remember, common fixed costs we do not allocate in our segmented income statement. So we can see now that the net income is $32,000. Okay, it did not change, right? If you look at the total column, the numbers are still the same. The problem was, in the book, the author or the managers of this company incorrectly prepared the formatted segmented income statement. Okay, so this was a review. Hopefully it clicked, right? So that's how you do an add or drop. Okay, when we come back in our next video, we're going to conduct a make or buy decision. So please tune in for that one.